Yeah, good day. Welcome to Excel Academy, Pathway to Success. In this video, we'll be talking about IAS 28, Investment in Associate. Yeah, and this is a topic under financial reporting. With your favorite tutor, Suluka Ahmed, SCA. So, first of all, we need to talk about what is an associate. An associate here is a company in which another company exerts significant influence over its operations. So this is what it means. That is, we have another company that exercises significant influence over the operations of the associate. So, and here now you would have a question in mind that who is the other company? Yeah, the other company here is the parent company. You get it? Yeah, that's parent company. And also would now move to the discussion of the term significant influence. So let me start by saying significant influence is a major um discussion when we're talking about investment in associate. And significant influence, it refers to the ability to participate in the strategic and operational decisions of the associate company. You get it? That is, it is just a situation whereby a company can, let me say, participate. That is, you can contribute your ideas, yeah, to the strategic and operational decisions of the associate. You get it? And also the significant influence, it is usually connoted. Yeah, it is usually connoted by saying 20% to 50% interest. So I would explain what that means. So that is when an entity, that is when the parent company has 20% equity shareholding in the associate company, then we can now call that a significant influence. You get, so it is not limited to 20%. That is between any percentage between 20% to 50%. So that's what we call a significant influence. You get it? And also where an entity holds 20% or more of the voting power, that is the equity shareholding, you get it, then it is presumed that the investor in this case is the parent company, has significant influence. I believe you're following. And also this significant influence that we're talking about, we can also um we can also call it the representation or on the board of directors or equivalent governing body of the investee. So I would explain that. Here now, when you say you have a significant influence, then you must have a representative on the board of directors of the investee. So the investee in this case is the associate company. You get it? Yeah, so that is, you must have a representative on the board of directors. And this representative would contribute the ideas on behalf of the parent company, or what we know as the investor. And also the second point here is that participation in the policy making process, that is including participation in decisions about dividend or other distributions. So this is what we're talking about here. That is, this parent company must actually have a representative also that would participate, that would be part of the decision making process, and also that is decisions that are regarding to the dividend or other distributions. Yeah, so that is what we're talking about here. And the third point here is the material transaction between entity and the investee. That is, okay, there must be some valuable transactions you got between the parent company and the associate company. And the fourth point here is the interchange of managerial personnel. So here this means that okay, the parent company can let me say tell some of its personnel to say okay, yeah, um go and take over this operation because maybe the associate company does not have a solid personnel, or does not have solid team for a particular activity. So the parent company can say okay, don't worry, just go and just go and replace those teams, mean that you guys are capable. Do you get it? So that's the fourth point. And the fifth point here is the provision of essential technical information. Oh, that is, the parent company or the investor must be capable of providing technical information to the investee or the associate company. So these are the 5 points that signifies significant influence. So, and also we have we move to the methods of accounting for investment in associate. So the first point is the initial measurement, which is also known as the cost method. So here now, here the investment in the associate, it is just recognized at the cost. You get it? That is the actual cost of the investment that was transferred will be recognized. Yeah, that's just for the cost method. And the second method is the subsequent measurement, or what we know as the equity method. So in this case now, the subsequent measurement is just a further step of the cost method. That is, it recognizes both the cost method, that is both the cost of investment, and other transactions that occur between the parent company and the associate company. And you will agree with me that in when we're talking about significant influence, I mentioned material transactions. So in this case now, these material transactions now will now be considered by the equity method. And also the subsequent measurement, or the equity method, is the most acceptable method of accounting according to IS 28. And also this method, like I mentioned, it takes into consideration of the transactions that occur between the parent company and the associate company. So I believe you are following. And also let's take a look at the format of investment in our associates. Like I mentioned, the first thing that will come there is the initial measurement, which is the cost of investment. Do you get? That is, you recognize the cost of investment in this case. And the second point here is the subsequent measurement. That is, if you remember, when I was discussing the equity method or the subsequent measurement, I said it takes into consideration of both the cost of investment and the other transactions that occur between the parent company and the associate. So these other transactions now will now be considered, and these other transactions include: number one, the associate post-acquisition profit, or what we call post-acquisition retained earnings. So you would agree with me that this parent company would also share the profit. Yeah, parent company will share the profit in the associate company. I believe you're following. And the second point in this case is the dividend. Yeah, there are cases whereby the associate will declare dividend. You get? So this dividend now, the parent company will also take their portion. But when we are discussing this investment in associate, that is when we want to account for it, this dividend will be eliminated, and this is the reason for you eliminating this dividend received. When we are sharing the profit, the dividend has already been included in the associate's profit. So So to avoid double counting, that is why we would have to deduct this dividend received from the associate. You get to avoid double counting. And the third point is the unrealized profit. So unrealized profit will come in when there are transactions between the parent company and the associate company. And this unrealized profit, it is the profit that is applicable on the unsold portion of the inventories. You get it? That is applicable on the unsold portion of the inventory. So we would have to eliminate such profit, and this profit we are eliminating to be the one that is exactly attributable to the parent company. So also let's take a look at how we treat those each and every transaction. You get it? So we'll start with the share of associates post acquisition profit, or what we call the share of associates post acquisition retained earnings. So you first of all, let's say the parent company has a 25% interest in the associate company. So you just say 25% multiplied by the post acquisition retained earnings. Do you get it? So you've already determined the share of associate profit. I mean the share of the parent. Oh, sorry, the share of associate profit that is attributable to the parent company. You get it? And the treatment here is you debit the investment in associate. That is, you add it to investment in associate. You also take it, you also add it to the consolidated retained earnings, or what we call the retained earnings of the parent company. Are we together? So, and the second transaction here is dividend received from associate. So this dividend received, you determine the parent company's portion of the dividend. You get so, and this is how you treat it. You deduct it from the consolidated retained earnings, or what we know as the retained earnings of the parent company. Then you now also deduct it from the investment in associate. So the third point here is the treatment of the unrealized profit on inventory. You get, and as I've explained earlier, the unrealized profit is the profit that is applicable on the unsold portion of the inventory, and the unrealized profit would occur as a result of the sales that occur between the parent company and the associate company. So you would agree with me that there are cases whereby at the end of the reporting period, it is not all these sales. These sales here I'm talking about is, let me say, sales of inventory. You get it? So at the end of the accounting period or the reporting period, it is not all these sales that would have been sold to third parties. That is, so the unsold portion, you would now determine the profit on it, and this profit you would eliminate it from the investment in associates, and this profit you determine the one that is attributable to the parent company. That is, let me say the parent company has 25% holding in the associate. So you just do 25% multiplied by the unrealized profit you get. So the treatment you pass here is you debit your consolidated retained earnings, and you also credit your investment in associates. All right, let's look at an example on this investment in associates. So we'll start with example 1. I believe the following, and here in this example 1, we're told that Abuja PLC, a company with a subsidiary, acquired 7.5 million shares out of the 30 million ₦1 ordinary share in Apache Limited for 15 million on 1st of January 2018. So in this case now, the Abuja PLC is the parent company, and Abuja PLC acquired 7.5 out of 30 million shares. So here now you would agree with me that the percentage of interest, okay, let me just start with this. Abuja PLC acquired, okay, so we don't know the percentage yet, so we now go ahead to say percentage of interest now. So percentage of interest here will now be 7.5 million shares. 7.5 million shares divided by 30 million shares. Do you get? So we have 30 million shares multiplied by 100%. Multiplied by 100. So you would agree with me that will give us 25%. So now you now say Abuja PLC acquired 25% of Apache Limited. Do you get it? Yeah, so that is the percentage of acquisition. That was the percentage of interest that was acquired. So the date of acquisition is as 1st of January 2018. So while the date of reporting here is okay, let's go. Let's report December 2018. Apache Limited earned profit after tax of 6 million, from which it declared a dividend of 1.5. They get, so that is, there's a profit after tax that was earned, and also dividend was also declared. So now to calculate the investment in associate, that will be statement of financial position. So in this case now, the date of reporting here is the 31st December. That was December 2018. You get it? While the post-acquisition period, the post-acquisition period here is just 1 year. Post-acquisition period here is 1 year. Yeah. So that's that. And what we'll do here again is that. So we'll now go ahead to do the treatment. So first of all, we already know the cost of investment. So the cost of investment here. The cost of investment here is how much? Cost of investment is 15 million. Okay, let's directly. Investment in associates. So it's actually easy. Yeah, it's easy, but you just need to understand the principles. Yeah, so here is 15 million. That's 15 million. So that's for the cost of investment. Alright, let's go to the second one. We're told that Apache Limited earned profit after tax of 6 million. So in that case now, we'll now do the share of associate profit. So share of associate profit after tax profit. Okay, yeah, that share of associate profit here will now be 25% of 6 million. You get, so 25% of 6 million. Let's calculate. So that's 1.5 million. You get, so is this 1.5 million that will be recognized? Yeah, 1.5 million. And how do we treat this 1.5 million? You say debit investment in associate. You get to debit investment in associate. You get to, and you now credit the consolidated retained earnings. So yeah, so debit investment in associates, that means you are adding it. So, and I've already added it here. So that's it. So that is be the workings. Alright, so that's that. We now move to another one, the dividend that was declared. So here now the dividend, we now calculate the dividend received by Abuja PLC. So the dividend that will be received by Abuja PLC will be 25% of the 1.5 million shares, that was 1.5 million dividend that was declared. So here is 375,000. So 375,000, and the treatment now. The treatment here is just easy. What you just do is you debit the consolidated retained earnings, and you credit. So you credit the investment in associate. So crediting investment in associate here is just so it is just deducting it. So how much are we deducting? 375,000. So deducting 375,000. So in this case now, we have determined the the investment in associates, and that amounts to 16,125,000. I believe you understood that clearly. Alright, let's move to example 2. Here we're told that if investment of parent PLC in associates limited represent 30% of its voting share capital, that is, parent PLC acquired 30% of associates limited. So here now, I'm told that the cost of investment in associates limited amounts to 4.5 million. But before then, we're told that parent PLC uses equity accounting to account for this investment. So this is specifically stated that we should use the equity method. You get it? And the cost of investment is 4.5 million. Alright, so now, do we have the date of acquisition in this case? Okay, we don't. So no, don't. It's not really important like that. So now, Associate Limited post profit for the year ended 31st March 2026 was 6 million, and Associate Limited paid total dividend during the year ended 31st March 2026 of 2 million. You get it? So Parent PLC has recorded its share of dividend from the associates in investment income. So in this case now we now do the investment in associates. So here now we are going that the cost of investment is how much? Cost of investment is 4.5 million. 4.5 million, and we're told that we are using equity method. Okay, so let's go to the workings now. So the workings here is that, first of all, the share of associate profits, share of associate limited profit for the year. Okay. So in this case now, 30% multiplied by how much? 30% multiplied by the profit. Profit is 6 million. So 30% multiplied by 6 million. Yeah, I mean that is 1.8 million. Alright, so the treatment is you debit your consolidated. You debit the investment in associates. And you credit what? You credit consolidated retained earnings. Yeah, agree with me. You credit your consolidated retained earnings. So just go, we'll come here, we'll say the share of associates limited profit. Share of associate limited profit. So and this is how we do it. So we have 1.8 million. 1.8 million. Alright, so now we're now told that Associates Limited paid dividend during the year ended 31st March 2026 of 2 million. So we will now calculate the share of dividend. Share of dividend received by Parent PLC. So in this case now, the Parent PLC will have 30% of 2 million. That will give us 0.6 million. That's 600,000. You get. So in this case now, all we just do simply is, since the Parent PLC has recorded its share of dividend received from associates in investment income and cash. You get. So since it has been recorded like that, what we'll just do majorly here is we'll eliminate it. So by eliminating it, and we are going to have this investment income is to still translate to still go to the consolidated retained earnings. Yeah, so what we just do majorly is we debit the consolidated retained earnings. and you credit what? You credit the investment in associates. Investment in associates. So that's that. We just go here. We say your share of dividend received by Brent PLC, and that's 600,000. 600,000. So you calculate that, and we'll sum everything up. So summing everything up, we arrive at 5.7 million. So that's that. That's that, and the investment associate. So the next video we shall be talking about. We shall be looking at questions majorly. Get it? So thank you very much, and endeavor to refer your friends to